This episode will look at the internal rate of return capital budgeting tool. Another capital investment evaluation tool is the internal rate of return, which equals the rate that yields a net present value of 0 for an investment. In other words, it is the interest rate that will make the present value of future cash inflows equal to the present value of outflows, or the cost of the investment. For example, ABC is considering investing in the following project. The project life has 3 years, an initial cost of $12,000, and annual net cash inflows of $5,000. There are 2 steps to calculate the internal rate of return. Step 1 is to compute an interest factor. To compute the interest factor for this project, we are going to take the amount of cash outflows and divide by the amount of cash inflows. The initial cash outflow is $12,000, or the project cost, and the cash inflows are $5,000 per year. So the interest factor is 2.4. The second step will be to use that 2.4 interest factor to identify the present value factor, which will be the internal rate of return. So we need to go to the present value factor table in order to do this. We are going to take the 2.4 and first go to the period row that equals the periods in the project's life. This project has a 3-year life, so we're going to go to the period 3 row in our present value table. We are then going to follow that row along until we find the interest rate that most closely comes to that in present value factor. So we calculated a 2.4, so we're going to go here and find that 2.40183 is the closest amount to the present value factor. Thus, the internal rate of return is expected to be approximately 12%. So comparing the internal rate of return to the company's hurdle rate, or the required rate of return, the decision rule would be, if a project's internal rate of return exceeds the hurdle rate, we would accept that project. However, if the project's internal rate of return is less than the hurdle rate, that project would be rejected as an option.